This is Traders Workshop with Adam H. Grimes. Hello, welcome to episode 5 of Traders Workshop. I'm your host, Adam Grimes, and you should follow me on Twitter at Adam H. Grimes. So let me begin this episode with a confession. I said I was going to try to do these in one take with basically no editing, and I've pretty much stuck true to that, except I'm coming back after finishing the episode and recording this introduction. You will hear several points in the episode. I referred to the title Conspiracy Theories and Magical Thinking, and I never got there. So this was originally intended to be a 2-part little mini-series. It's going to be 3. So the title of this episode is How to Think Part 2, and the next episode will cover Conspiracy Theories and Magical Thinking. So with no further ado, here's episode 5. That topic actually does not really play a central role in this episode, but it teaches us something important about how we think and how we evaluate beliefs. This episode is also a continuation of episode 4, which was titled How to Think. So if you, by some chance, you found this episode first, I would suggest you go listen to that. And then let's jump right in. Okay, so real quick review of that episode. I said when we're evaluating any trading idea, the key question we want to ask, of course, is, does it work? But it's not such a simple question to answer. To answer it, we have to be able to think statistically, to think in terms of probabilities. And that's a recurring theme. I'll tell you that right now through all of my work, all of my teaching, all of my personal development is to cultivate that skill of thinking in terms of probabilities. We talked about how the market works against learning, how the market has actually evolved to provoke us naturally to want to do the wrong thing at the wrong time. And a lot of developing traders think they must be so stupid that they make these mistakes. You're not stupid. This is just what the market does. This is why the market is able to exist. And until you understand that, it's kind of like understanding the matrix to step out of the matrix, if anybody still understands that reference, right? And also the random reinforcement of the market. We didn't really talk about that in terms of learning theory, but random reinforcement will actually make a behavior much more permanent than a regular reinforcement. It's important if you're trying to train an animal or train a trader, same thing. Actually, I'm not sure there's any difference at all. Okay, and then the last point that I kind of left off with was that we're really buried in misinformation on this topic, and hopefully we're cutting through some of that. So let's jump in here by picking up right there and think about that question, does it work? So you've been presented with a trading idea, or you've come up with a trading idea, and before you go risk your hard-earned money and precious time, and I'd argue maybe your time and emotional energy are even more valuable or just as valuable as your financial capital. Before we risk, we want to have some answer to that question, does it work? And I will point this out. The ultimate answer to that question is probably your trading results. If you trade, and I don't mean just go do one trade and see what happens. I mean, if you trade as a program, if you trade with discipline, and what I mean is you're doing pretty much the same thing over and over, not running from one idea to one idea, because then, of course, we can't evaluate anything. But if you're executing a type of idea or a trading idea with consistency, and you look at the results of a large sample of trades, your actual trading account, in some sense, is the ultimate statistical test. Because over the course of any set of trades, you're going to win some money and you're going to lose some money. And one way I think about it in a real basic way is just imagine physically that you're piling up dollars. And both piles of money, if you do a lot of trades, will end up being pretty big. Except the money you lost is actually negative money that's subtracted. And what you really hope is that the pile of the money you make is bigger than that pile of money you lose because you get to keep the difference. That's really how it works. And all of the testing, all of the back testing and forward testing and statistical analysis, that drives us to a theoretical understanding of that. But your trading account, this is an idea I want you to carry away from this podcast. Your trading account is really the ultimate statistical test. It tells you, does this idea work for me? Now, it's not quite that simple because a lot of other things play into it. But if you keep the idea of your trading account being the bottom line, truly the bottom line, that will orient your thinking. When I said it's not so simple, I guess I shouldn't just blow that off. What do I mean? Well, sample size is an issue. You could potentially, let's say you have this great plan for picking stocks and it picks very infrequently. So let's just say you can maybe find 2 stocks a year. So I would suspect if you could trade that system for a few years, and maybe you end up with 4 or 5 stock picks, and perhaps just by luck, even if your system would work over a large set of trades, maybe those 4 or 5 are all losers. So you might walk away from it thinking this is the worst idea ever, and my trading account shows 5 losses in a row. I'm not going to waste time on it. So sample size is something to consider, and there are ways to mitigate that, but there are, in fact, very good trading ideas that may just not occur enough to really be worth trading, or may not occur often enough for us to really evaluate with any degree of reliability. And one of the problems, I'm just going to throw this out there, and a lot of you can object to it. One of the problems with doing statistical analysis in financial markets is we don't really have that much data. There really isn't that much market in financial, not that much data in financial markets. And I know many of you are thinking, oh, we're buried in data. And if you look at other disciplines, many disciplines have much more data, orders of magnitude more data than we do in financial markets, even intraday tick data, even quote data. So sometimes we just don't have enough information to evaluate an idea. There's also, of course, the element of luck. I just suggested a test where you got very unlucky. And the reality is traders hate to face this. Traders fight against this. Traders get so upset when I point this out, but luck is important and luck matters. And your results ultimately will have a component of luck in. What it mixed in with the results. What you're hoping to do, of course, is to be able to work around that luck, but it's always going to be there, and it's going to be there in terms of streakiness. And that's a topic for a future podcast. It's a topic for an whole podcast too. We also do need to think about how will I know if I have an answer to does it work? And this is actually a really interesting question because this gets us into the field of epistemology, which is where we look at knowledge about knowledge. And we start to ask some questions that seem really obvious at first. How do we know something? How sure can we be that we know something? What do we know about the quality of that knowledge? What do we know about the process of acquiring that knowledge? And, we tend to really gloss those over, right? How do you know the other cars are going to stop at a red light? Well, you just kind of know. And if you really think into some of these issues, and the word is epistemology, which, it's a big word, but really what it is, we want to understand how sure it's knowledge about knowledge, how sure we can be of our knowledge and that our knowledge represents some kind of truth, which is itself a slippery concept. When you really dig into that, you find that a lot of things that you thought were very obvious are in fact not at all obvious. And some of the things that you take for granted are relatively new in the history of human thought. And some of the things that you take for granted were really flummoxed a lot of the greatest minds and greatest thinkers in history. So it is definitely worth thinking about what do we even mean by proof? What can we mean by proof? And for me, personally, this is a very practical perspective. We can talk about philosophy. We can talk about abstract things all we want, but there does come a point where I'm going to sit down at a trading screen and I'm going to push a button to make a trade. And when I make that trade, I'm going to risk my money. So it also has this very applied edge. And when I think about it in practical terms, I think of it in two ways. And these are closely intertwined. My standard for does a trading idea work is, can I reproduce it? Meaning, of course, the obvious thing is, can I reproduce it next year? Can I reproduce it 10 years down the road? And I will say there's been one of the ongoing narratives in financial markets is all of the ways markets are changing. And those of you who've been in the market for a few years, talking about HFTs, talking about the advent of electronic trading, tick sizes changing, different changes in volume in markets, changes in composition of markets, more, stocks, the prevalence of ETFs. There are all of these ways that markets evolve, and all of these ways that both the infrastructure, the maybe microstructure would be a word we would use, but also kind of the big picture, just what are financial markets? Have you traded the Deutschmark recently? No, you haven't. But when I started trading, that was a market that people traded a lot. Pork bellies, same thing. So markets change, markets evolve. But the interesting thing is that I've been able to build my career around things that don't change. And does this mean they're always going to work in the future? I don't know that. It's an epistemological question, but I'm reasonably confident that because I can look through literally the entire recorded history of financial market data, and I can see that markets traded in a way that are consistent with the framework that I use now, and I can be reasonably sure it's probably going to work 10 years from now, 2 generations from now. Maybe, who knows how markets will evolve in the future. It's a very interesting thought game. You can't imagine. Could you imagine, for instance, financial markets exist because we're trying to allocate insufficient resources, right? On a fundamental level, it's particularly obvious with commodities, but you probably could even say the same thing with capital and stocks and bonds. What if we had some other way, maybe a very scary way that plays in with the current narrative is, imagine a benevolent artificial intelligence that could allocate resources. Under that type of situation, maybe you would have no scarcity of resources. Maybe you would see financial markets largely go away. So, these are interesting, kind of cutting edge, maybe sci-fi ideas more than trading ideas. I think it pays to think around the corners in some very bizarre ways, but I'm going to turn the screen on Monday and I'm going to make trades, and that stuff really doesn't matter that much. It can't matter that much because I have to deal with the reality of right now. So at the same time, we think very big picture. We also think, what is going to let me know that I'm likely to be able to reproduce this and also reproduce in other markets? That, frankly, is a problem with evaluating ideas, because I can show you ideas that work very well in stocks but don't work in currencies. I can show you ideas that work very well in commodities and currencies but don't work in stocks. I do think you want to be careful about slicing it too finely. For instance, one, let's say, catastrophic backtest mistake would be, let's say you have a trading idea and you test it on a bunch of futures markets, and you come back and you say, okay, Adam, this works really well in gold, not on silver, doesn't work on crude oil, works on heat, doesn't work on natty, works on soybeans and corn, doesn't work on wheat. So you come back and you say it works in these markets. Or maybe you check a bunch of currencies and you come back and say it works on cable, it works on Swissy, doesn't work on the euro yen, doesn't work on the Aussie, works on the Kiwi. So you have you have these ideas, you have these, what looks like your idea works in some specific markets better than others. I would be very careful with that. I think that's a mistake, because what I bet you would find, if you had the perspective of a larger algorithmic test where you could go back and look at thousands of events, you would probably see what you're pulling out there is a variation in randomness. If the trading idea really works, it pretty much should work in all currency pairs. Now, maybe there's some exception to that in the short term. Maybe particularly algorithmic systems can be finely tuned and refit. I do think you risk overfitting, but that's a possibility. But in general, I would stand by, in general, I think your process should be to try to find things that work relatively well in all markets. And if you have an idea that, look, I can show you my trading history, that just because of and people, I think, are misled by streakiness. Like you might look at trading pullbacks, and you might see, if you're trading pullbacks in commodities, that you go through a period of a year and a half where every pullback you made in corn failed. But then you'll turn a corner and it'll start to work again. There's nothing going on there, I don't think, other than just kind of the bubbling and jumbling of randomness and noise. It's very easy to be misled by randomness. And unless you have a pretty good grasp of statistics, it's dangerous to, you got to do it, right? Because it's how you're going to learn. But just be aware that it's dangerous to start playing around with backtesting, because what will look intuitively correct to you may be very, very wrong. So when I say reproducibility, I do give some allowance for focus on asset classes. I'm not going to trade big spike reversals in currencies. I could trade those in stocks. I could trade that kind of daily mean reversion. I'm probably not going to trade breakouts mechanically in stocks. I'm not going to trade breakouts mechanically anywhere because I don't like the return profiles, but I could get away with it in futures. So I am aware of that, but keep it on high level asset classes. If you have a system that really just works in silver, I'd be a little careful. Maybe, of course, you know how to verify it, and then you know how to monitor your performance. That's not really the topic here. The second standard that I have is that I want to be able to transmit it. And what I use that word transmit rather than teach, but you can think teach. And this is one reason why I'm such a jerk sometimes when other people are talking about trading ideas, because, standards of proof. Here are my standards of proof, right? I want it to be reproducible. I want to be able to transmit it. And another person might have a standard of proof that if someone else is using it, it works. That's a common thing you see in online discussions. Somebody is using Fibonacci ratios, therefore Fibonacci ratios must work. Well, first of all, you don't actually know that person is unless you've seen their account statements. People can lie very convincingly, and I'm always suspicious. But even assuming that that person is in fact telling the truth, and that person genuinely believes the Fibonacci ratios are why they make money, if those ratios are not what is actually making them money, they're not going to be able to teach you. And this is where a lot of people are. Trading systems are complicated. Mine aren't, but a lot of trading systems are complicated. People are using 5 or 6 different things to make decisions, and they have all of these convoluted rules. And so the edge may not lie where they think the edge lies. And if the edge comes from the combination of these things, or from something that they think is insignificant, a friend of mine tells a story that I forget what the guys were trading. I think maybe they were trading hog futures. There was a group of farmers who kind of became famous for trading hog futures, and he went to see what they were doing, and they actually entered based on the swing of a pendulum, which you can think of it as a flip of a coin. It's something that paranormal researchers use, how pendulum swings. So it's probably not an analytical method that is something you can reproduce. But we'll talk about things like that here in just a few minutes. We are getting there. It's a little teaser. See what I did? And he looked at what they were doing. He discussed what they were doing, and he was really baffled. But they were, I believe he knew their brokers. So he actually knew that these gentlemen had pulled substantial amounts of money out of a market that's really wickedly difficult to trade. And he's just standing there scratching his head. The guy said, there's just one more thing. It's a little thing. We don't even really think about it. But we get into position and we do what the pendulum says. And if it doesn't work out right away, we get out. So you see what's happening is maybe they had a random entry method, but they had some type of trade management. And that trade management was, if it worked, they trailed to stop. If it didn't work, they got out pretty much right away. And obviously, they didn't get out in 5 minutes. So they had some rules and they had some sense about how the market would react. But these people did not think. I don't think there was any effort to deceive. They truly believed it was the magic swinging pendulum that told them to go long or short on hog futures. And this little trivial thing of trade management, it's not even really worth talking about. But I guess as long as we're telling you everything, we'll tell you that too. But it's no big deal because it's the magic pendulum. They genuinely believe that. But imagine if you had tried to learn. I think this is where you are in many cases today. This goes back to the misinformation. There are many people who are genuinely trying to teach, but because they have not subjected their own trading to this type of rigorous thought process, they don't know why they can make money. And I would argue they probably don't know that they can make money in the future. But if they don't know why they can make money, they're in a very poor position to be able to transmit it. And I know that from working as a musician and teaching as a musician too. If I tell somebody, okay, to get this sound out of this passage on the piano, you imagine the spark in the top of your head and the sound coming out of the top of your head, and you feel very light on your legs while you sit on the piano bench. That might very well be my experience playing. But what the person really needs to understand is how to align arms and fingers and how to transmit weight to the keyboard and how to balance different volume levels of notes in the chord, how to move their arm, so that there are all of these mechanical things that are actually what's important. But as an artist, I might be thinking sparks in my head. And so to teach means, yes, having that conception of where we want to go, to use the music analogy, the artist conception, but also being able to step down and think like a technician. By technician, I don't mean a technical analysis person. I mean somebody who works very closely with the mechanics and details of the thing and say, okay, well, this is what's actually working. This is what we actually need to do. So those are my standards. I would offer that I think those are fairly decent standards to start with, and you probably should develop your own. But if you can't reproduce, to me, reproducibility is hard to argue with. If you can't reproduce it, then what are we talking about? And that's one reason why I'm kind of critical of ideas like buying penny stocks, buying marijuana stocks that are very cheap. Even if you can make money with it now, that's a fun lottery ticket thing, but I don't feel that I can build a career on that. I don't know enough. And one of the other things that makes this really hard to answer this question is the effects are small. Even the best edge is quite, and we talked about this, the best edge is quite small, and it may also vary across time. I could have a strong edge. Let's say, just for reference, I'm looking at a system that trades daily bars, and I backtest 5 years of data, which is probably not enough, but I might find that over that period of 5 years, that there are significant periods of time, maybe 3, 6, 8 months, maybe even a year or more, where it doesn't really work. And of course, if I start trading during one of those periods, and with my luck, I always do. I'll just tell you that when I pull the trigger, it's in one of those environments. It can make it quite difficult to really see the big picture, and that also goes back to the problem of saying, "Hey, it works in silver, but it doesn't work in gold." Are you sure? Or are you just looking at noise? And legitimately, effects can vary across asset classes, and that's because momentum and mean reversion are different in asset classes. But we'll talk a lot more about that in the future. It's also possible, you must admit, that effects could combine in unpredictable ways. So in other words, maybe those Fibonacci numbers, which I have tested extensively, I'll just bullet point, I've tested extensively, and I've been looking for an edge and I haven't been able to find an edge, which doesn't prove that Fibonacci's do not work. In fact, it's not possible to prove that, but I have not been able to find a clear effect in the data, let's say that. And in my personal trading, I have elected to not use Fibonacci's in any way whatsoever, and my trading got better when I did that. So I would also argue that you don't need them to trade. But even though I would make that argument that I can't find an edge, is it possible that if you combine them with some other tool, that maybe there is an edge? Yes, absolutely. And that, of course, should be testable. If you're telling me that the Fibonacci works when combined with the magic money line, which Tom told me I misrepresented. The magic money line was not a moving average. It was simply a horizontal line drawn on the chart. It was a support. It was a resistance area. So here's my breakouts of resistance. So, I was just crushed or gutted, as our UK friends say, that I had misrepresented the money line. Not really, but yeah, right. But, I'm joking a little bit here, but seriously, it is possible that there could be combinations of tools could show an edge in combination, but not singularly. And that would be something we would definitely need to investigate. It's also very possible you could have an edge and couldn't apply it for various reasons. Lack of capital, lack of emotional control, lack of discipline. All of these things are things we can address, but to me, it's not at all a given that if you have a system with an edge, that you can make money. I had a friend who would develop algorithmic trading systems. That was what he really loved. And he would go through this development cycle where he would develop systems, and then he would start trading them, and he would instantly start tinkering with them until the system would blow up, at which point he would decide it doesn't work, so he would go back and develop other systems. Why? Because he really enjoyed the process of system development. So he was, as Ed Seykota says, everybody gets what they want out of the market. I paraphrase, but what he wanted was solving the market puzzle. And to do that, he needed the constant challenge of not having something that worked. So, you do kind of have to think about it like that. The ironic part of that story was he sold many of his, quote, non-working systems to hedge funds and made substantial money from that. So he had things that worked. People paid him good money for these things that he personally developed and was not able to trade for his own psychological reasons. That's an interesting story, which we should probably revisit in the future. So what I want you to do? I really want each of you listening to this podcast and reading my work, thinking about my work. I want you to become skeptical. I want you to cultivate a data-driven perspective. And that sounds, to some of you, that's very natural. To some of you, people come to this from all different perspectives, right? Some of you have PhDs in quantitative disciplines, and you could run circles around me mathematically and probably logically. I absolutely accept that. Some of you come from very artistic backgrounds, and you're not real sure how to do arithmetic. Let's just be honest. And the spectrum in between. So to some of you, if I say data-driven, that sounds really sophisticated. All I mean is that you're going to look as honestly and objectively as you can at what you see. And here's a thought. Okay, so we all have beliefs, right? And wouldn't it be a great thing if those beliefs somewhat reflected reality? That's what we want, right? You don't want to have beliefs that are completely misaligned with reality. So how do we get there? Well, one of the smartest ways to do it is to have a belief, and then as you see things, as you experience things, we would say, gather more information, gather more data, you modify those beliefs. Now, those of you who are quantitatively inclined, you know exactly what I'm talking about, but I'm not going to use the word. An example of this would be, let's talk about ESP. Okay, so now we're getting closer to magical thinking. And let's say you come to me and you say, Adam, I am very good at reading pieces of paper that are sealed in envelopes that I've never seen. That's a skill that I have. And now, what would I think about that? Right away, how likely is that? That's a question I'm going to ask myself. I would be inclined to think it's not very likely. Is it absolutely impossible? Well, no, few things are absolutely impossible. So I could not say with confidence to bet my life that it's absolutely impossible. But I would say that I think it's really, really unlikely. So that would be my first perspective on that. And then what would we do? I would say, well, let's run some experiments. And maybe I'd have you go in another room and I'd write something down and put it in an envelope, and you just come in and do your thing. And what if you were able to tell me what I wrote on the envelope? Well, that would be a data point that should make me modify my belief, right? I didn't think it was very likely. Well, now I've just seen something that's kind of hard to explain. Now maybe I think it's a little bit more likely. And then what do? Well, maybe we do the experiment again. And then maybe I think, maybe I don't really know what I'm doing here. So maybe I call up some friends who are professional magicians, and I say, hey, can you make sure this guy isn't, that there's not some sleight of hand, there's not something I'm not seeing here. And we would do it in more controlled conditions. And what if I kept setting up these barriers and you kept showing me that you could, in fact, read something that I wrote in an envelope? Well, that would modify my belief, right? Or it certainly should. Given enough experimental evidence, I would kind of be an idiot to cling to that belief that it could not be true after I'd accumulated enough evidence. Now, we're operating from the perspective of belief. And because my belief in that initially would have been very, very small. What's the probability you actually have ESP? Pretty darn small. And in my worldview. However, somebody else might have a different perspective. What if somebody else, let's just use me. So let's say I believed in ESP and you came to me and you said that. And I said, yes, okay, I think it's quite likely. People can do that. That makes perfect sense to me. And then we would structure an experiment. And I'm now going to, because I started out more confident, I'm not going to require all of these other experiences, right? I'm just going to be able to see a little bit of proof. And I'm going to be an even stronger believer. On the other hand, if I started out as a strong believer and let's say you failed your experiments, I'd maybe need to modify that belief, right? So, and you get the idea, I think. I mean, I could keep talking about this for a long time, but the idea of modifying our beliefs based on evidence that we see is a powerful way to think. And again, this is something that may seem super obvious to you. You may be saying how could you do anything else? But I think the reality is it's not quite as obvious as we think. Was not that obvious for a lot of human history. And I think even today, you think about very emotionally charged fields like politics, religion, trading. Yeah. And, things that where a lot of emotion or trading where a lot of risk is involved. And people sometimes don't make those modifications very well. It's just something to think about. And we'll also talk a lot more about that in the future. And like I said, if you come from a quantitative background, I'm actually talking about a specific branch of statistics, which is a very useful way to think. So if you can start to think like that. And if you do think like that, think even more like that in terms of really evaluating your ideas in context of the data, the experience, the experiments that you run. And every trade is an experiment. Every back test is an experiment. And then you develop the skills of being able to create better experiments. This is going to get you closer to understanding if and when you have an edge. And of course, this also goes back to that idea I talked about a little bit in the last podcast, where you're starting to really think in terms of probabilities and statistics. You're not really thinking about, can I solve this puzzle once and figure out what stock to buy? You're thinking about, can I create a reproducible, sustainable, we could use some other words here like reproducible and transmittable, which is kind of a weird word, I guess, but it's a word, process. The same thing that I can do over and over and over. Can I put my trading into that kind of framework? It's going to serve you very, very well in trading. Now, to do this, one of the criticisms, I want you to get a piece of paper, okay? Get a piece of paper and something to write with. And if you're driving, don't do that. If you're driving or running and jogging, don't do that, but at least keep this in your head. If you're at home, get a piece of paper. Let's do an experiment. One of the things that I am often criticized for is people think I'm too skeptical. And, I think this of myself sometimes. Maybe I'm too confrontational. But here's why. Let me show you why I would argue it's good to be like this. So take your piece of paper, please, and draw a kind of big box. I'm going to do this with you, so you hear me drawing too. And leave room to write beside the box and below the box. So you've drawn this big square and then draw a cross through it. So you now have a box with 4 quadrants. So you have 4 little boxes inside your box. Okay, so now beside the box on the top, label this believe, meaning I believe. And then label the bottom, of course, do not believe. I do not believe the thing is true. And then under the box for the left-hand column, label this, it works. And then on the right-hand side, it does not work. Okay, so what I've done here is, and in case you're kind of holding this in your head, let me read that to you again. So we have a box with 2 rows and 2 columns. So there's 4 boxes within the box. The top row is labeled I believe. The bottom row is labeled I do not believe. The left column is labeled the idea works, the trading idea works. That's what we're talking about. And the right side is labeled it does not work. Now, here's what I want you to think about. First of all, what is the probability that a trading idea works or does not work? My belief, based on long experience, knowing thousands of traders, doing thousands and thousands and thousands of back tests, is that most trading ideas do not work. Though there are many there are many ways to make money in the market, most trading ideas do not work. So just randomly given a trading idea, not knowing the source, not knowing anything about it, I believe you are quite safe. You will be wrong sometimes, but not that often if you say it does not work. So that's one thing we have to understand. Most trading ideas do not work. And if you disagree with that, please go trade for a year or so and then come back and start listening to my podcast again. You'll have a different perspective, I think. And if I'm wrong and you go trade for a year and you're making a pile of money, then don't come back and waste your time on my podcast, right? You don't need to waste your time because you have found your own way. So with that framework in mind, what happens if we are in this bottom right-hand corner? So this is the idea does not work, and I do not believe it works. Well, what's going to happen? I am not going to trade the idea. Let's write that down. I won't trade it, and I'm not going to lose money or time. And both of those are kind of equally important to me. And there's also some emotional trauma to consider too, frankly. And I know it seems kind of silly to talk about that, but it's not at all silly to talk about that. So if the idea does not work and I do not believe it, really no consequence. Now, what if the idea works and I believe? So we're in the upper left-hand corner. I believe the idea works and the idea does in fact work. Cha-ching. Done, right? Profit. That's very simple. That's where we want to be. Okay, that's simple also. Let's look at the lower left-hand corner. So this is the trading idea actually works, and I reject it. I do not believe the idea works. It actually did work. So that was a missed opportunity. Well, that's what I'm going to write there. That is a missed opportunity. I do not spend much time here. I do not lose money, and I do not lose much time. But I could have made some money. So there is a little bit, there is a small loss here, but it is nothing like the loss, the upper right-hand corner, if I believe it works and it does not work. Now, you might think you couldn't live in that space very long, but I know traders who have lost millions of dollars trading ideas that do not work. And they've had ample evidence. Some of these traders, I've seen trading records with hundreds of consistent trades, and it's very clear the idea does not work. And I personally have seen a trader who lost about $8 million on an idea. I'm not making that number up. And he genuinely believed it worked, but all the permutations and combinations of it, there was really never, it was a remarkable losing record. That's where you really get hurt. So now look at this box, and if I would encourage you, start this over without me. Draw the grid, think about it, think what it is like to live in each quadrant, and you will see why I would prefer to reject an idea. And no, again, for those of you with quantitative backgrounds, I'm not going to talk about type 1 and type 2 errors, because the intuition here is what matters. The practical application is what matters. I am much better off throwing out good ideas than I am accepting bad ideas. So therefore, plus, since most trading ideas don't work, I should be skeptical. And I want you to be skeptical. I want you to be skeptical. And how do you get something through that filter of skepticism? Well, it has to pass your test. You know what? This actually has gotten to be a 40-minute podcast, and we did not get to conspiracy theories, which I said was the subject the subject of the podcast. Let's save that for next time. So this will now be a 3-part podcast series, and next time we will talk about what can go wrong with beliefs. We'll look at magical thinking, conspiracy theories, and just generally what can go wrong. Okay, I would like you, if you could, please, wherever you found this podcast, subscribe, drop me a good review. That really helps the podcast get momentum. This is a new podcast, and I anticipate doing this for quite a long time. I certainly thank you so much. If you've already left a review, thank you so much for your time and support. If you haven't done that, that's a thing that you can do that will take you a few minutes that really will make a big difference. A lot of times people think, oh, it doesn't matter. You know, there's so many people listening to this that my opinion doesn't matter, but it does. It matters a lot. So if you could, please leave a review. Also, follow me on Twitter at Adam H. Grimes. And I'd like you to check out my blog. You know, I have a couple companies, and I'll talk about those in the future. But just for now, go check out my blog, adamhgrimes.com. I think if you poke around there, you'll find some interesting perspectives on trading ideas and see some very practical and very applied trading tools. Okay, I will see you back soon for the next episode, in which we will finally talk about conspiracy theories. Thank you very much.